Kia ora, I'm Nadine Higgins and welcome to your personal finance podcast, The Prosperity Project. I am on a mission to empower you financially. And while I work in finance, I'm a columnist, a journalist, an investor, a financial advisor, and a mum of two. I do not claim to be the font of all knowledge. So each week, I'll be bringing in the experts from across the world of finance and beyond to find out all the things you and I need to know. And if you want to get your questions in front of those experts, please email them to me, nadine.higgins at nzherald.co.nz. Today, New Zealanders are among the most underinsured in the OECD, according to the Financial Services Council. We insure our cars, our houses, our stuff, but arguably not our biggest asset, ourselves. And Givealittle fundraisers for families that have hit hard times and need help are so common. But is insurance the answer? And if so, why don't more of us have it? Joining us now is insurance advisor Willie Moala. Kia ora, Willie.
Glad to be here.
Insurance is not renowned for being the most enthralling topic in most people's minds. So I'm just wondering, respectfully, when you go to a party and people say, "What do you do?" and you tell them, what reaction do you get?
Wow, I don't know if I should be offended by that. No, just kidding. Yeah, look, I think it's fair to say that it's definitely not a conversation starter. I think if you went and dropped that at a party, you'd probably lose friends pretty quickly. They'd probably all find somewhere else to be. But yeah, look, it's just something that you can't touch or feel, take home, does not give you warmth, unless you need to call on it. But otherwise, it's something you can't see. So it's really hard to get excited about things you can't see, right?
Yeah, and look, I say that from personal experience. When I used to tell people I worked in television, they wanted to know all of the things. And now when I tell them I'm a financial advisor, they're like, cool. So I feel you. We are going to get into in this episode demystifying some of the types of insurance and the things you need to know about it. But I would love to hear some of the stories you've experienced, because I know for you, it's about the people you're dealing with, right? I wondered, have you had anyone come to you for advice and you've given them what you think they should do and they haven't taken it and regretted it?
Yeah, that's a great question. And that's almost my biggest fear, is that you engage with somebody and you go through a process where you make some recommendations because they clearly have a need. And that person, for one reason or another, decides that they're not going to act on those recommendations, which, by the way, that's totally fine. People are making educated decisions that they just would rather not participate in the insurance, and that's fine. Look, fortunately, that scenario hasn't come to fruition too many times, but there's one story that really sticks out to me. Met with a really lovely couple who had just moved from overseas, and they were setting up camp in New Zealand, and this was going to be their long-term home. At the time, they had two young children who were both in primary school, and the couple themselves, they were really lovely people. They were very busy professionals, is probably the best way to put it. And it was always a struggle to try and get time with them. So when we were trying to meet, so this was back in the day when you had to meet people face to face. Yes, there was once upon a time where you had to do that. Yeah. And I vividly remember that every time we met, it was always pretty rushed. And it was really hard just to grab their attention because they had so many things going on at that particular time. But the short of it is that we went through a process where we looked at their situation, and it was really obvious that they had a ton of needs. They were going to be buying a house that was going to incur a very large debt. They had two young kids in school, and they didn't have the luxury of a wider family safety blanket. So they were really on their own if something was to go wrong. Look, and so we went through a process. I made some recommendations, and they decided that they just weren't going to pursue it. They were just busy. And so the insurance just really didn't become a priority in the end of it. So that happened, and then probably, I can't remember exactly, maybe about 4 years had gone by, and I hadn't heard from this couple, but I got an email from one of them, and it was basically them filled with regret that they hadn't taken action on any of the recommendations that I had put together, and that unfortunately the partner that had emailed me was diagnosed with terminal cancer. And so what that meant for them was they were basically left without any support system, and the financial worries kicked in really quickly. So what I imagine happened that particular person's thought process was, crap, life is literally going to be passing me by pretty quickly. And then I think that changed really quickly to a focus of financial worry. And that's, even now, that's one of the probably like the toughest emails that I've ever had to receive from a client. And it's one that you never want to receive. But within that email, the person was pretty honest about that. In hindsight's great, right? It's always easy to say in hindsight. But that person's view was that in hindsight, they had clearly made a decision that had far-reaching consequences. And if they could have the time back, it really wasn't a burden to put some time aside for that because it was so important. But at the time, they had other things that were just a bit more of a priority. So it was really easy for that person to look back and reflect on that. And while it wasn't going to help them this time around, they were fairly happy for me to share that story with others in the hope that they could avoid that. That person has since passed away. But that, from time to time, especially when I have to talk about it sort of brings up memories, and it's not the space you want to be.
No. Do you think then that the reason more people don't go down the personal insurance route is that it's time consuming? Is it that it's costly? Is it that they just think it's an expense for something they don't feel like they're getting anything out of? Or they're just hoping for the best? What do you think the reason is?
I think there's probably a perception in the public that is fairly universal, right? And that is insurance. Yeah, but it's not going to happen to me. I hear lots of horror stories. When you're chatting around a barbecue, the stories that come out around the insurance are typically not that great, if I'm honest, which is a real shame because I've been in this industry for 15, 16 years, and I have seen nothing but absolute determination from the insurers to try and find ways to support people when they need it. Now, unfortunately, probably, the 1% to 2% stories that we all hear of, typically in the public forum, are not that great. And so that becomes the dominating voice around the insurance piece.
So is it kind of trust? People go, I might buy a policy, and then when I need it, they won't honour it.
100%. Yeah, 100%. That's the perception. So that's a real challenge for us. But what we find is that when people actually talk to us and engage with us, and we can sort of, pull the curtains back a wee bit more and go, hey, actually, this is what happens in the real world. People are better off for it. But yeah, probably public perception. I think it'll always be a bit of a challenge for us to get people to move across and be more interested in this space because of perception. I think that's my view on it anyway.
Yeah. Let's be really clear here. People might not know what we mean when we say personal insurance, but there's a distinction here, right? This is not your car insurance policy or your house or your contents or whatever else, pet insurance. What do you mean by personal insurance?
Insurance is, I always find this an easy way for people to understand. It's insurance for human beings. That's probably the easiest way to put it. So things like medical, income, disability, that sort of thing.
And do you think, is there also a perception that if something bad happens, that the state will just kind of look after you? Because obviously we have ACC. If you have an accident, there is help there. But do you think that in people's minds we just extrapolate that out and think, well, if I get cancer, if I have a stroke, if I have a heart attack, someone's going to look after me?
You do get a lot of that, right? So a lot of it is the state will look after me. But I also think it's probably more from the she'll be right. So when they say that the state will look after me, I think that's just a bit of a cop-out because they just don't really want to think about it because of perception again. There's certainly some people that would be in that school of thought that, hey, look, if it gets really bad, the government will support me and I'll be okay with that. Totally, there's a large proportion. Well, I mean, the stats that you said at the start in terms of percentage of people who have it probably says that is the case.
Yeah. I'd like to do a little bit of demystifying with you if I could, because obviously life insurance, I mean, that is what it says on the tin, right? It's insuring your life. If you die, it gets paid out to your spouse or your children or whoever. And I guess it can be paid out if you have a terminal illness. But some of the others are maybe less obvious. So can we talk about trauma insurance or total permanent disability? Why would I get those insurances?
Okay, good question. So we'll start with trauma. So trauma is a type of insurance that will pay you. So life insurance, if you pass away, will pay other people. It'll pay your estate, or all that money will go to your family. Trauma insurance is more concerned about paying you, the person who has gone through some sort of illness. The way that trauma works is that, let's say we want to take out $100,000 worth of trauma insurance. Now, in order for us to receive that payment, we would have to be diagnosed with one of the insurer's list of very specific conditions. So an insurer might have anywhere in the vicinity of 50 to 60 very specific conditions, and some examples would be heart attack, stroke, cancer. So they're very significant. And if you were to have one of those illnesses occur to you, then the insurer would pay you, in this case, your 100 grand, and you do with it as you please. It's paid off as a one-off lump sum. Once that benefit is paid to you, it's typically done. There's usually there are things you can do to have a second shot at it, but typically it's a one and done type of policy, and that's what trauma is. And it's right up there in terms of the different types of benefits that we see utilise the most. Now, the reason that's the case is because cancer, as I said before, is one of the conditions. It just seems to be in New Zealand. I don't know why. It just seems to be a lot of people have cancer in New Zealand.
Yeah, I think that would be reflected by most people's experience. Everyone knows someone and has been touched by it in one way or another. So what about total permanent disability? Is this like losing my arm or something in a workplace accident? Is that not covered by ACC?
Well, it's a good question. So total and permanent disability, we often refer to as TPD, and the way that particular benefit is triggered is in the name. So if you find yourself in a situation where you become totally and permanently disabled, then the insurer would pay you out again. So we'll use the 100,000 K as an example. So if you find yourself in that situation, the insurer pays you your 100 grand and you do with it as you please. Now, in terms of defining what that means, that is, if you have a situation where through an accident or an illness, you could never return to work again. So that's really specific. So it's not around having specific illnesses occur to you. It's around, have you had something that preventing you from returning back to work ever again? Now, the comment that you made around ACC is really important, because that's what a lot of people ask us. Because most of people, when they think of becoming permanently disabled, they instantly gravitate to, oh, well, it's got to be an injury. Well, actually, that's not quite the case. So if you think about a stroke and a severe stroke, for most of us, that would mean we're never returning to work again. So in that case, ACC is not coming to the party. There is no money from ACC. Now, if you flip that and you say, well, what if I have an accident? That's more obvious, and I can never return to work, and I get my payout from this TPD policy. That's great. You've got your lump sum. And for a lot of us, we'd also be covered by ACC, who are going to pay you 80%. That's usually the case. They're going to pay you 80% of your pre-accident income, and they're going to pay you that every week, yeah? So I think there's a difference in probably what that lump sum is likely to do versus the money you're likely to get often from ACC. The money from ACC, I sort of see that as paying the bills that are ongoing forever. They'll keep coming through. And the TPD money is really to pay for things that you could otherwise not afford to at the drop of a hat. So if, your lifestyle's changed and you have to make modifications to the home, to the car, you usually need to have a whole bunch of money to make those purchases.
So both of those types that you've talked about, the trauma and the total permanent disability, are kind of lump sums that come in. Where does income protection factor into all of this? And is this, I can take it out if I think I'm going to be made redundant, or is it only for other reasons?
Well, not surprisingly, with what's going on in the world at the moment, especially in New Zealand, redundancies, I don't remember a time where people have asked me more redundancy questions than they ever have in the past.
Yeah, I bet.
It is probably not a week that goes by. Redundancy cover and income protection are two separate covers. So that's probably the first distinction I'll make, is because people often ask me the question and they'll think it's one and the same, just the way that you've described it, but they're not. They're completely separate. So we'll start with income protection. Income protection is a benefit that will pay you every month if you're unable to work because of some sort of illness or accident. So it has to be some medical reason. So if you're off work, then that insurer will pay you every single month. Now, the way that is triggered is it's not defined by having a specific illness or accident. It is anything medical that prevents you from working. So if you think about the scope of that's huge, because there's a million medical reasons why you might not be working. And so if you're in that situation, the insurer will pay you every single month. There will be a stand down that applies. So that stand down is something that you will determine when you set the policy up. And so often people will have a 13-week stand down. So if I become unwell tomorrow, it's not going to cover me if I'm off work for a couple of weeks. But if I'm off work for 13 weeks or more, this thing's going to kick in every month. So very different from TPD and trauma.
So does that mean that that's the one that's going to be the most expensive of the lot?
Yes, because the threshold to claim on that particular benefit is much lower. The bar is very, very low compared to the trauma and especially the TPD. They have quite high thresholds. So yes, you can expect that you're going to pay a lot for that benefit, but potentially it's probably the one that you're most likely to utilise. This
might be a curly question, but if you could only afford to have one of them, is there one that you would say, have this one?
So if there was a pyramid decision-making chart,
yep,
probably the income protection. It's the one. You and I can do the things that we like to do in life because we have an income. Most people don't have the luxury of not having to rely on income. Most of us have to rely on that. The income protection is the one benefit that is purely focused on making sure you continue to get that even if you can't work. So arguably, it is the most important one. That would be it.
I was expecting you to bat that question away, so well done. We are going to take a quick ad break now, but after the break, I want to ask Willie about how not only to get the right level of insurance if you're going down this personal insurance track, but also whether there are some ways that we can make it more affordable. Back after this. Welcome back to the Prosperity Project. We're talking to Willie Moala, an insurance advisor at Advice First. And the next thing I want to dig into, Willie, is obviously people look at insurance as a cost and it can be expensive. Are there ways, though, that we can get it the right level of cover but make it cost effective? Or am I asking too much?
How can we make it cheaper, basically?
Yeah, that's what I'm asking, yes.
Yeah, how can we make it cheaper? Okay, win lotto. No. So when we take out insurance, that process requires us to disclose a whole heap of information to the insurer about our health. So the insurer want to know, tell us about your family history, tell us about any medication you're taking, and they'll use all of that information to determine how much you're going to pay in premiums. Now, for some of us, we may be doing things or have conditions that mean that our premiums are actually going to be a bit higher than what the market rates are. So some examples of that is, if I take out some insurance and I'm a smoker, if someone who's the same age as me, male, takes out that same policy, they're going to pay a lot less than I am because I'm a smoker. So things like being a smoker, there may be something called a loading. So your policy may have a loading in relation to your health. So what that means, what a loading means is, I'll use an example of high blood pressure. So you have particularly high blood pressure, and as part of that, the insurer's assessment is that, hey, look, perceivably you're a little bit more higher risk than most. We're going to charge you an additional premium for that cover. And so we've given you a loading of 100%. What that means is you're paying 100% more than anyone who does not have a loading, okay?
Okay, as you heard the sharp intake of breath, because I have a loading on my personal insurances. I was going to say asking for a friend, but this is just for me. If you're anxious and you have a loading, how do you get rid of it? You have to become less anxious, do you?
There are some things that are just simply out of our control. So your health is something that is out of your control. But then there are some things that are in your control. So if we focus on the things that are in control that you can help to reduce the cost, then we'll focus on those things, okay? So I'll talk about some common reasons why there are loadings, and then if there's anything we can do around it, okay? So within New Zealand, there's this very prehistoric, and I'm going to upset some people here, there's a very prehistoric tool, I don't know if that's the right word, that we will describe whether or not somebody is the right height for their weight. So that's me being very PC.
Yes.
Called BMI. And so some insurers, not some, all insurers will consider someone's BMI as whether or not they're going to get a loading. So if your BMI is above XYZ, then the insurer will charge you additional premiums for that and call that loading. Now, thinking about your health, thinking about what's in control, if you decide, hey, look, I'm going to do something about this just for myself and I'm going to get focused on going to the gym and training and all the rest of it, if your BMI comes down to within healthy range in the future, we can go back to the insurer and tell them that and say, hey, look, my BMI is in healthy range. You had a problem with it previously. It's under control now. Reevaluate that. It's the same with smokers. So if you were a smoker and you're on a health journey and you've stopped smoking, particularly for 12 months, then you can come back to the insurer and say, hey, look, let's have a discussion. I've stopped smoking. How about reducing those premiums? So those are just two examples, common examples of things that you can do to help reduce the premiums.
What about exclusions because of pre-existing conditions? You know, you've had a recurring knee injury or you've had surgery on something before or whatever it is. Can you insure that away? Do you just have to pay more or is that just off the table?
Often when an insurer will exclude like a body part or certain types of conditions, they will just usually exclude it. So you wouldn't get an exclusion and a loading. It would just be an exclusion, okay? Now, often when you get an exclusion, insurers will tell you, or they'll tell the advisor, whether or not that particular exclusion is reviewable or not. So some exclusions will be permanent and some will be reviewable. If it's reviewable, the insurer will usually give you some guidelines like, Nadine, your knee's excluded because last week you injured it in indoor netball. But if you can have no recurrence of the injury and you don't go to physio or you don't have any need to have any more investigations for this for 2 years, we'll consider removing it. So they'll give you guidelines on whether or not you can get those exclusions reviewed, but usually you don't get an exclusion and a loading for that at the same time. So
getting healthy and getting rid of the loading is one way to bring down the cost of the premium. The other thing that I've been told different things about, because obviously insurance tends to get more and more expensive as you age, but you can choose a specific type of policy to stop that happening. Tell us about that and when it's worth it.
Okay. So this is called, or what we refer to as a level premium. So for most people in New Zealand, their premiums will go up every single year because they're getting older. Now, for this purpose, just to keep it really simple, I'll call that a stepped premium. So let's say 90% of the population in New Zealand have what is called a stepped premium. That is, every year I get older, the insurer will increase my premiums. There is an alternative, which is what you've alluded to. And that alternative is I don't want to have my premiums go up every year. So in return, I'm going to pay a level premium that's not going to go up every year, but I have to pay more now, immediately. So I did somewhat prepare an example because I thought this might come up. So as a real life example, we have a 30-year-old male and he wants 200,000 K of life cover. He's got two options. So the first option is he can pay $22 per month on a stepped premium, or he can pay $95 per month on a level premium. So I'll just hypothetically, what would you choose, Nadine?
Well, I mean, if you're just looking at the dollars, you're like, what? Why would I pay 95 when I can pay 22? But how quickly is it going to get over that? You know, is it 10 years? Is it 15 years? How long does it take to pay off?
I think you answered the question, which was, what would you choose? Because most people, the 90%, they choose the step premium. I don't want to pay 95. So the challenge is is having the foresight to know that I'm paying a little bit more today, but I'm going to be far better off in the future. So if we keep that same example, and this 30-year-old is now, say, a 60-year-old, that same premium is now $191 per month. So it's taken a wee while for that to get to that point, but that's at age 60. If they hold that policy till they're 70, then it's $700 a month. If they hold that policy till they're 80, that's $2,500 per month. Now, there's a whole bunch of arguments to go, well, who needs that life cover at that age? Yes, no, I understand that. But for some people who still have a genuine need and they're holding on to those policies, unfortunately, there's no real end in sight because they chose a premium that goes up every year. So we'll have parents in that who are going through those massive increases. Go and talk to them, because if you could tell them go back in time and choose one or the other, I'll tell you which one they'd choose.
Yeah, I bet. And I guess if you wait another 10 years to choose level cover, then it's even more expensive to account for the fact that you've waited another 10 years.
Exactly.
I don't know if this is a curly question or not, but I'm sure you have to tell your clients, but how do insurance brokers get paid?
So insurers will pay an advisor or a business effectively what is called commission. So if you take out a policy with me, Nadine, and that is, let's say, for example, you pay $1,000 per year for that particular policy, the particular insurer that we have placed that business with will pay a commission, which is based on a percentage of what you're spending over that year. So they'll pay some sort of percentage, and that is how businesses get paid effectively.
So do people go to you, hey, Willie, aren't you just invested in getting me the most expensive insurance policy because you get a percentage of it?
I'd like to think not, but yeah, you're right. It's an elephant in the room. Fortunately, within the organisation that I work for, our advisors are not paid a commission. So we don't receive a commission. And so that removes a little bit of the elephant in the room, because irrespective of whether or not that person places business with I or my colleagues, we're still getting paid. So that's a win for everybody. But yes, Advice First, or the business I work for, would receive that commission for any business placed.
And what is the benefit of coming to see you as a broker rather than ringing up NZI, AMI, State, whoever the insurer might be, and saying, hey, can I have a life insurance policy?
I think the value of the advisor, first and foremost, will be the experience. So there'll be a lot of experience that they would have gone through. They can help the navigation part. They can help with, and I talk about this a lot, the deciphering. That's a huge part of this, is the deciphering.
Yeah, because it's a bit bewildering.
Oh, yeah. I mean, some light reading, if you want to have some light reading, go to bed, then read some insurance documents. That'll put you to sleep really quickly. But those
then we can remove that insomnia loading.
Yeah. Those would probably be the main reasons why.
Yeah. And what about when it comes to claim time? Like, can you fight on my behalf, or do I have to go into battle with the insurer on my own if they say, oh, no, sorry, we're turning this one down?
Any advisor that's worth their weight in will be there as part of that claim process. So the advisor themselves may not be doing everything, particularly if they work within a business that they have a larger support network. And so there'll be different people within that organisation that are supporting the claim in various stages. But look, part of the reason why we do this is because that's when the rubber hits the road, that is when we are called. So I've got a person that I'm currently working with right now. That person has gone through a very successful round of treatment for what they were going through. It was very grim. They were told they had less than 12 months to live. Really sad. They've got young kids. But part of that process was that I could say, this is one thing you don't have to focus on. You just have to focus on getting better and spending time with your family. Look, as a side note, as part of that claim process, it actually helped to fund them to go and get treatment overseas, which would otherwise be really costly for them. But I was there through that entire process. In fact, I just was meeting with that person for lunch. But particularly going through that claims, especially when things get a bit niggly, you need to know you've got someone, a champion championing you in your corner. So for sure, can't believe I missed that one.
And what is the trigger to get insurance? Like, is it I have to wait until I've got some debt, or until I have children, or some other point in my life?
I think when you don't have a whole heap of surplus money, which is it an oxymoron? Because that's like when you need to buy it. I think I used that correctly, but that's usually a real good indicator, because what it means is you haven't built up enough of your own reserves to have an emergency fund, to have these really, so
you've got no financial resilience, and so you kind of need to buy some?
Right. You said it better than I could. Yeah. So you've got a whole heap of financial exposures. You've got kids that are relying on you. You've got a mortgage that needs to be paid. The bank doesn't care if you're unwell tomorrow. You've got to pay that. You've got all these bills, expenditures to pay for, and you don't have the resilience right now that if you couldn't work, you could you need the insurance to pay for something. I think I answered that okay.
I think you answered all of it okay. And I just realised there were other questions I've got, but we are out of time. And I'm just so grateful for you answering the questions so openly and honestly. That is Willie Moala from Advice First. Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories, nadine.higgins@nzme.co.nz. A reminder, though, that this podcast is informational only and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change. Doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project.